Income tax is a big topic, and it's a little bit difficult to delve too deeply into it because the rules can change from year to year as new tax laws and tax codes are passed. What we want to do is hit some of the highlights to get some of the basic concepts down, and even as we do some of these kind of simpler versions of the real calculations, you'll probably start to see why people hire accountants or turn to TurboTax or other computer software to generate some of these results, if that's not what you're already doing. First, we want to look at identifying someone's gross and adjusted gross income. So gross income is just the total of all the money that you've earned in a year. Any employer-paid wages will be reported on a W-2. Income from any freelance work. So if you get hired not as an employee, but just to do some contract work, freelance work, would be reported on a 1099 miscellaneous, MISC. Income from investment income, investment interest, will be reported on a 1099 INT, short for interest. And then your adjusted gross income AGI is your income minus any deductions, which we'll start looking at in just a minute. So employer-paid wages, freelance wages, investment interest, those are just a few of the ways a person might make money over the course of a year. Not included here is reporting self-employed income and other options that exist, other ways of making money. But in example 1, we're given the following information, and we want to find this person's gross income. In order to find a person's gross income, again, what we're going to do is just add up all of the money they brought in. In this case, the person has wages, interest income, and freelance income. Adding those values together would give us a value of $54,400. In part B, we want to find this person's adjusted gross income. Now what we're going to do is subtract out any deductions. In this case, we have an amount that's deposited into a tax-deferred IRA. So that $2,600 is not counted as part of your income. You'll be taxed on it later after you draw that money. Mortgage interest from your home loan and property tax are examples of other deductions that can be applied. So to calculate that adjusted gross income, we would take the gross income of $54,400 and then subtract out all of those deductions, which in this case totaled to $10,900, leaving us with an AGI of $43,500. It's also important to note here that this value we just calculated, AGI, is not the same thing as your taxable income. Starts getting us closer, but there are also exemptions that might apply for disbursements from a health savings account, bond interest that's earned, or gifts that are given under a particular amount, which again changes from year to year. This isn't an inclusive list, but again, ideas of exemptions that might apply that could bring down your total taxable income.